What are the safe harbor rules to compute estimated tax penalties to avoid paying underpayment penalties? I'm going to explain it with an example. This is Nashima, the CEO of Infotaxcar.com, and I request attorneys, tax preparers, taxpayers, entrepreneurs, students, economists, and the most important politicians who create laws to subscribe to my channel to receive the most up-to-date and accurate tax information to enhance their knowledge. I'm going to apply 90% safe harbor rule and 110% safe harbor rule in order to compute quarterly estimated taxes to avoid underpayment penalties. Here is a case study. For a 12-month period, Chris Becker's 2023 tax return showed an adjusted gross income of $160,000. Becker can avoid the penalty for underpayment of estimated taxes for the year 2024 by paying the required annual amount in a timely manner. We have two choices. We have to find out which choice is correct, or she can use both, or she has to apply both. Number one, the 90% tax on current year return will be paid in 4 equal installments. Number two, 110% of the tax liability for the previous year paid in 4 equal installments. Since her AGI is exceeded by $150,000, so she has to apply 110% safe harbor rule. But she cannot also avoid the 90% of the current year safe harbor rule. A taxpayer can use either one or two options, but is a taxpayer AGI if $160,000, they fall into the category where the 90% safe harbor rule requires them to pay 110% of the tax shown on the return for the previous year to avoid penalties. If they only comply with the 90% rule and not the 110% rule, they may be subject to an underpayment penalty. In general, a taxpayer can avoid underpayment penalties if taxpayers pay estimated tax equal to either 90% of the tax on the return for the current year or 100% of the tax liability of the prior year. However, since Becker's AGI exceeded $150,000 on the prior year's return, she must pay 110% instead of 100% of the prior year's tax liability if she wants to qualify for the prior year safe harbor rule. To prevent underpayment penalties, a taxpayer must comply with both the 90% and 110% safe harbor rules. Let me just explain quickly or summarize it quickly. What are these three safe harbor rules? 90% is used based on the current year liability. 100% safe harbor rules is used based on the previous year liability, whereas 110% rule safe harbor rule is applied based on the prior year liability, but only if the AGI is exceeded by $150,000. Thank you and God bless you.